Okay, good evening. வணக்கம். இந்த வெதரில் பொருட்படுத்தாமல் வந்ததுக்கு ரொம்ப நன்றி. First of all, this event was a much awaited event. ஏன்னா ஒரு 3-4 மாதமாக நாங்கள் பண்ணுறதுக்கு ட்ரை பண்ணிகிட்ருக்கோம். ஆள் கிடைக்கும்போது பிஜி அவைலபிள் இருக்க மாட்டார், பிஜி அவைலபிள் இருக்கும்போது ஆள் கிடைக்காது, இந்த மாதிரி. ஸோ இட்ஸ் பீன் கோயிங் ஆன் ஃபார் லாஸ்ட் 3 months. Finally, we come to this date. This is more than marketing. It's a information session for you all. நிறைய பேர் இங்கே you might have bought your house, or you are a new home buyer, or already bought a house, want as a investment property, and the solution is here. Biju and Idle Loans. They are about the company itself. They have been our sponsor for almost 4 years now, continuously. You all might be knowing them, but very good mortgage broker, I would say, in the sense, very complex. I would take mine as an example. Mine is a very, very complex loan, and he made it happen. So that's how it is. I'll hand over to Sinoj, and their complete team is here. Shibu, Sinoj is looking after the marketing side. Over to Sinoj.
Thank you, Chris. Good evening, everyone. And Chris, thank you for you and your team to organize this event. I think what you said is right. It's been 4 months that we are trying to organize one of these events here. As Chris said, once we get the hall, the date is not convenient. When we get the date convenient, we don't get the hall. Obviously, I'll try to introduce my team. I'll start off with Bindu. Do you mind just coming in, please? Bindu does home loans, refinancing, very active in the Malayali community. Pretty much all hands, you can say right hand to Shibu. Next one I'll introduce Ivan. Ivan does mostly on commercial lending. He's an expert in that side of things. So if anyone wants to see business loans, commercial loans, car loans, that's the person there. Then we have Jisha. Jisha does all the back-end work, credit analysis, any credit checks, all the files, talking to the team. So everything that happens on the back end of the site, Jisha handles that. Then we have Shankar. Shankar does mostly from new home loans, car financing, anything that you can see on his list there at the back. That's what Shankar is, his expertise. I'll introduce you to Nita, the backbone of Shibu. Pretty much without Nita's help, I think Shibu might not be able to do this. Thank you. Then one and only Shibu, founder, director, you can name it. He's pretty much the whole and soul of Ideal Loans. He's the one who has taught us pretty much all the lending side of things. So any technical questions, he's the master of it. I'll hand over to Shibu so he can start with his presentation.
Thank you, Sinoj. Thank you for the great words. Thank you. Good evening, everyone, and thank you very much for coming into this fantastic event organized for Smart Finance and Property Workshop, organized by AT Adelaide Tamil Association. And as Sinoj and Chris said, we've been waiting to organize such an event for a long time. And unfortunately, so the venues, our convenience, and everything are not matching to each other. So that's why we had to postpone and to bring into another stage. So we really appreciate your time for today, for coming in this very bad weather. And we are mortgage brokers, as we said, like in Ideal Loans. We are mortgage brokers.
Small announcement. We are also recording the whole event to put in our Vaagai Radio later on. So hope you all don't mind.
We are mortgage brokers lending from 2016 onwards, and supporting all the communities in Adelaide and as well as in all over Australia. We have offices in all the major cities, and we are catering all the communities, basically Indians, and over 80% of businesses belongs to, like in multicultural community, and 20% belongs to local community. So, and we are supporting in all residential, asset finance, commercial, and SDI properties, business and commercial finance, car loans and personal loans, super fund investments, commercial development finances, pretty much everything in lending, we will say like an except credit cards. so which we are not allowed to do. And we do have 85 aggregators, we have 85 lenders we are working with, and we have a wide range of products, more than 500 individual lending products and 18 asset finance companies. So we are working close with all the lenders, major and minor, first tier, second tier and third tier lenders we are working with, just to make the people's dream come into the reality. So in this session, so it's an interactive session we are planning for, like you can ask your questions, raise your hands, and may I know like how many of first home buyers are here actually? So any first home buyers is planning? Okay, because I thought like into whether to elaborate more about that topic, or maybe other guys might be feeling a bit boring, but I will go on with that, I'll be going with that topic at first actually. So first thing, when we are introducing ourselves to you, so everyone might be thinking about whether we need to go into a branch or need to go for a broker. So what is the advantage? Or because we can go to any of the branches, major lenders branches, or why do we need to go for a broker? Like to explore your details to them, whether they are there in the community or whether the other person will know it or not. But we have very heavy obligations and rules and regulations, privacy protections and all, because this is our bread and butter. So we don't want to, mix anything with that. So always, when you're going to a broker, there is a lot of advantages because individually they can analyze your cases based on your requirements, which might not be meeting with one lender, which you are walking into. There will be another 5 options with other lenders because every lenders can't do everything because we have major lenders, 5 basic pillar of Australia, the major mainstream lenders we are telling about, and we have second tier lenders, third tier lenders, which is all catering in different way. Some lenders might be giving 90% loan without LMI. Some lenders, yes, you need to pay LMI. So when you're walking into a banking directly, they can't say, okay, so just walk into the next branch. They are not allowed to tell that because they only can say, okay, come on, sit here, we will do the loan. They can't guide you into that direction. Even they might know it, but whenever they're working in some places, they can guide you into another places, or it's totally against to the ethics. But for us, we don't have any such commitment to the banking because we always need to. We're working for the people, so we always need to look into your needs, and based on your financial situations and circumstances, we need to understand it. We need to guide you. Okay, these are the dishes. You just select one. Okay, so you might be having an appetite for going to a direct branch, which is having a branch access, or sometimes you might be okay to go for an online banking, which might be more competitive because they are not spending that much of administration or overhead cost, which is always cheaper. So this is all based on your requirements. If you're a doctor, you might be able to go for 95% no LMI. So if it's a registered, it's 90. So these are the options. So you always need to look into that direction. And so this is the advantage when you're going for a broker. So when I started my business in Australia, which is in 2016, roughly around 25 to 30% of lending been done by brokers, and the remaining was doing by branches directly. But now the things been changed. Most of roughly 74.8% of lending is doing by broker channel because it's more accessible to the people. It will be more easy for communications because you can talk in your language, you can share your ideas very easily. You'll be having long conversations, you'll be having long appointment time, long time for, after our working hours, you can call on Saturdays, you can call after 5 o'clock, and there is a lot of flexibility for doing that. Some of the documents might be able to deliver to your home, if you want, you're working by up to 5 o'clock, then you're asking for an appointment by 6. If you can make a fixed appointments after that time, or if you're having three or four friends who want to discuss about an investment strategy, we can tell you in that way as well. So there are more flexibility, and the banking products, sometimes people might not know whether you need a flex offset product or a basic product. We don't know, when we are going for a loan. So we don't know what is offset, what is basics, and we will be a bit shy to ask what is that actually, but we will tell you, okay, just go for this according to your savings pattern or anything. So easy for selecting products rather than avoiding much administrative cost as well. And in lending side, we can guide you the lending easily. And on top of that, when you're looking for a property, it will be very hard where to look or what way need to go for a bit of motivation. People will be looking to buy a property, but always need a bit of push. Like into go in this direction, give a bit of confidence to them, or they'll be concerned about, I am renting this much, okay, say for $400 per week, my mortgage will be coming maybe something 800. So whether it is working out, how I can make it profitable. So all these questions will be answered in a single shot when you guys are meeting us. So, and apparently you're not paying anything to us. So we are not charging anything directly or indirectly to you guys, or the bank is not charging anything extra to you, anyways to you, because they are reducing the staffing. We are bringing the business to the banking without paying anything. And the biggest thing is, if you are giving out from that banking, we might be losing the commission. Sometimes 1 year, sometimes 18 months, sometimes 2 years. So we'll be with empty hands, and the bank doesn't have any cost for that. So they don't have to put a staff, they don't have to put an after-hours staff, and they don't have to pay anyone for not bringing clients or not to cater the client for the entire 2 years' time. So these are the advantages for you're coming to a broker. Like you'll be getting a free advice, and you can discuss with, okay, I found a property, is it a land and construction is good, and we'll be going according to your advices, and we'll be discussing with you, okay, this will be good, or okay. So we will help you to sort it out, those things. And also, we are not just buying the properties. We will be with you for, we want to be with you for 60 years, 100 years with you all, because it's not ending with purchasing a property. So we need to guide you when purchasing investment property, how you can buy a car, how you can use the equity. So these all things are going around. So we always say, when purchasing a property, the relationship starts over there. It never ends, because everyone thinks, okay, purchase a property, they put the money into the pocket. Okay, it's not that. We are starting from there, actually. So your comfort, your referrals, this is making the business to us. So 76.8% of loans are doing by the mortgage broking channel at this moment. That might be going more, I think. So that's why the banks are reducing the branches, because more people are accessing to us. And about first-home buyers, always it's a big dilemma to make a decision whether to go for a first-home. There are a lot of options in the markets. So when I came to Australia, there was no much options. So straight away go for pay LMI and buy a house. But in this current situation, you might be having a lot of government grants, and there will be a lot of government benefits. You guys can use it when you're going for a first-home buyer. So first thing is, so individuals who are purchasing a property who is getting $15,000 first homeowners grant. So in South Australia, there is no any limit for purchase price for getting that grant, but the house must be a brand new, no one lived in, no one rented out, fresh brand new house. And there is no any property cap value, and also you can purchase a land, no stamp duty, and also when you are doing a construction, you can get a $15,000 first homeowners grant if you are a first home buyer, eligible first home buyer, which is a permanent resident or an Australian citizen. So either one of that, if you have a partner and the partner is a spouse visa, or like if the partner is a temporary resident, still the other party is a permanent resident or a citizen, they will be eligible for $15,000 grant. And also for the first home buyers, there is no price cap for stamp duty exemptions. It must be a fresh brand new house. And also for land. But you need to pay transfer duty, which is other component, but that's a very minor part of that cost actually. And then there are different options. The stamp duty exemptions I already explained to you. And there is another grant which you might be heard about, First Home Guarantee Scheme, which is we call NHFIC scheme. So unfortunately, the price capping for that participation is $600,000 in South Australia, according to the postcodes. In regional areas, that is $450,000. So our property market is really high. So usually first-time buyers are not fitting into that category, which is 5% minimum deposit, and you don't have to pay LMI. No matter what profession you're working with, as being a first-time buyer, must be an Australian PR or citizen. So in that situation, both the applicants has to be Australian permanent resident, which is an initiative by federal government for supporting first home buyers. 95% no LMI. That is the first one. First home guarantee scheme. And so the minimum deposit is 5%. And when you are comparing all these benefits, it's so easy to purchase a house, but the purchase price is only the biggest thing. And regional home care, we have 35,000 spaces and spots are available for this financial year for 25-26 in that scheme. And family farm guarantee, which is for single parents, so they need to only have 2% deposit if the purchase price is in $600,000 limit. So which is still that might be possible if you're purchasing a brand new townhouse or brand new units or anything in such a range. And later on, when the family is growing, you can go into upgradation, and this will be becoming an investment property in the future. So that's a smart act. Actually, I don't know why people are going to 1 million straight away. So always start from the scratch, buy a small property, no matter it's a townhouse or unit, no need to invest a lot of money. Purchase a property, get along with the market, and go for an upgradation later on when the equity is growing up, and you use the deposit for the next purchase. I will come to the topic later on. So these are the options. So first home, which is calling first home guarantee scheme for the federal ministry, and that is coming in that category. So South Australia, the purchase price, as I told you, $600,000, and for regional areas, that is $450,000. So 2% deposit. A lot of people are asking us whether we can purchase a property with 2% deposit. Don't mix with the previous offer. This is by state government, which is by homestead. So people who don't have much deposits, they will be able to purchase a property with 2% deposit as a primary residence. Okay, so that should not be an investment property. It must be always an owner-occupied, which is a primary place of residence. So if you have a certificate 3 or graduation, even from overseas, working on the same category here, yes, it will be eligible for that, or the trades assessment or anything. Sometimes you will be getting an exemption for that. So 2% deposit. When we are comparing all these things, yes, the deposits comes less. So the maximum loan limit for this category is $750,000, which is by homestead, a bank governed by state government, which is owned by state government. So interest rates, unfortunately, a bit high, but there is no mortgage insurance. So we will always call that as a startup bank. So start with that. Then on the way, when our income or the equity or our savings going up, we can move into a normal lender. So we are not supposed to stay there for a long time, because when we have savings, we can move into the normal lenders. We are not locked anywhere. So that's a good initiative. So these are the eligibility criteria for getting into that space. 2% deposit, which is calling graduate loan. So that category will be always helping everyone to purchase a property with 2% deposit and the remaining 98% loan. So we have a scenario, actually, someone who want to purchase a property with homestead. This is a comparison we just bring for first-time buyers. When someone want to purchase a property with homestead, or someone want to purchase a property with in a normal lender. So someone who want to purchase a property with 760. Why we put 760 is when 98% loan is coming, it should not go beyond $750,000. So we need to limit in that space. It was 950, bring down into 850. Now it is 750 limit at this stage. And in the first scenario, you can see that if the particular client, Mr. John, is going into a normal lender, he need to pay minimum 5% deposit. When you're paying minimum 5% deposit and not using any of that NHFIC schemes or anything, we all need to pay mortgage insurance, unless it's not a registered nurse, or if not having 10% deposit as registered nurse, or a medical professional. There are specific categories, which is, say for example, an engineer. It's a very good profession. IT is a very highly paid, very good profession, but they don't have that exemption in that category. So in that situation, with the government stamp duty, LMI, transfer duty, and everything, they need to pay roughly around $60,000 for purchasing a property after deducting that first homeowners grant. So we calculated based on someone who is purchasing a 760K property with utilizing, is a brand new house, utilizing all the benefits, state government, no stamp duty. They only need to pay a transfer duty of $7,600, 5% deposit, $38,000, and roughly, it's an approximate LMI We can't say exactly because the lender to lender that will be different, and that's based on the value of the property as well. Roughly around 26,400 for a random figure we put it for, and the conveyancing and other associated costs we just put a bit extra. It might be usually 1,500 to 2,000, but we just added as 3,000 as a buffer. $75,000. The FOG is a federal state government guarantee, like in FOG, First Homeowners Grant. Which is deducting from their $60,000 with a normal banking. And that mortgage insurance, which is $26,000, we are just putting into the river. We never get it back because that's going to the insurance firm. So we never recommend that much to spend that much of money into that. And the second scenario, which is a 2% deposit, which is a home start one. We got the same 2% deposit, which is $15,200, and $7,600, which is the transfer duty of the state government, which is everyone need to pay, and zero LMI. There is no any LMI. And the banking cost, the bank got roughly around $1,860 their application fee, and the remaining for $350 for the valuation. That's why we just increased that cost $4,000, including the conveyancing and other associated costs. And if they are eligible for First Homeowners Grant, the customer need to have only $11,800 for purchasing a $760,000 property with utilizing the stamp duty exemptions and utilizing the First Homeowners Grant, so they can have this property, $11,800. Sometimes in that $11,800, we might be able to go for, if the price is a bit lower, there will be a new starter support will be giving by Homestead, which will be another $10,000. So that will be adding on that. So the deposit will be too less. So $11,800 is not a big amount to go for a property. If we are planning very good, if we are maintaining our expenses very much in a proper way, if we are affordable to pay that loan in that situation, that will be possible for most of the people. And another one is the owner-occupied investment purchase without any deposit. That's another topic we just basically cover there. First-home buyers, low deposits, first-home buyers, grants and things. And owner-occupied investment property, usually this is for everyone actually. Someone is having a property and they want to purchase a next property. So that's the biggest question everyone is asking, Shibu, can we get a property? Can we purchase a next property? Because when I arrived in Australia, most of the people might not be having a property. Everyone was scared to purchase a property or purchase a brand new car, but the thing's gone. So everyone is having a brand new car. Everyone is going for a second property, or the first property will be a bit of luxury, and second property and third property. Nowadays, if someone purchased a property in the first year, then we are usually getting a call after 1.5 years and asking for, can we look for a next property? How is the equity? Because people know a lot in the market than us. So usually the question will be coming from there. So if you have a property, usually we will say if your property has a very good appreciation over the period, because the market is going up, we are seeing that in front of us, we can utilize the equity of the property to utilize the deposit and stamp duty cost of the next purchase. So pretty much, someone has a good property and has a good value, and if they have a borrowing capacity, we can go for the next property without spending any single dollar from pocket. So they need to have good income to service the loan, and they need to have a property value which is appropriate to the next purchase. So this is always possible for people to purchase and go for investment properties in the future. That's a big part of business we are doing actually, because all our customers who purchased a property, they might be having 2 properties, 3 properties, long-term relationship, and we just set them up how to purchase more properties or more property, like into portfolios, to generate the portfolios. This is the main core business we are doing in our existing customer sector. So the first thing is using the equity of the first property, which I told you. If we have a property, say for example, the property value is $1 million. $1 million is a normal price in South Australia. Sorry to say that, but it was a dream like to have $1 million property in South Australia long time back. But all the properties, whatever we see around here, which is all $1 million. So if we have a property value of $1 million and we have a loan of $500,000, we can use the equity up to $800,000, which is 80% of that $1 million. Special cases, as I told, nurses and all, we might be able to go for $900,000 with using more equity up to 90%. This money is going to be the deposit for your next property. So that's why we usually say we can go for a property with 106% LVR, which is loan to value ratio. So utilizing the equity of the property. Or you might be able to use parental, if any of you have a kid, your kids are older, like in 23, they started to work, they don't have a deposit because they might be saving money gradually, and the parents' mortgage might be gone down into a 40% loan or 30% loan. We might be able to secure the parents' property against to the next purchasing property, and we can use the parental guarantorship to purchase the kids themselves by putting all the loan onto their head. There are some legal documentations need to be written and signed off, but in that situation, the kids can purchase a property with securing or attaching or collateralizing parents' property and using for the next purchase as a guarantor, which we are calling as family guarantee. So without having much deposit, kids will be able to go for that. The advantage is because the percentage of loan is very lower, so that's where they might be getting a better rate, and they might be able to go for a better banking as well. So most of the major lenders are doing a big role and help in that space because parents giving their property as a security, and the kids can purchase a property by using the security and the percentage of the value against to their property and taking the loan fully on the kid's name. And there will be some legal obligations. You might need to get legal advices from the solicitor, and the banks, some of the banks need the consent letters and the solicitor sign-offs based on that. That's all individual choices. So that's an option for everyone to purchase a property in that space. And so anyone have any questions about the second property purchases? Or do you want to put it to the end point? Oh, yeah. Another question is everyone is asking, because when we are getting into a 38, 40, 45 years, everyone will be asking a question about how can I pay off my mortgage, because my mortgage is going up again, because we are the people, we will be using the equity from the property and letting you to purchase the next property. Just going to tell about whatever I told you just before, so like to reduce our mortgage. We will take the equity from the property, yes, that's for next investment, but don't feel bad. Whenever we sell that investment property, the deposit is coming back to your property. You can pay off your mortgage, and whatever the profit from the property is coming to pay off your home loan. So there are a lot of ways you can use for reducing your home loan before 30 years. The first thing is your repayments. If any of you are making a repayment in monthly basis, we will suggest you to go for a weekly or fortnightly basis, your mortgage repayment, because the advantage is the repayment is going into your home loan earliest as possible, and you are not paying the interest for that much of days. I mean, like in 1 week or 2 weeks, that much of days you are not paying interest for that portion of money which went into the home loan itself. And you are saving bits and pieces, a little bits and pieces for 30 years. That makes a huge difference to everyone. So when we have a property with that roughly around a $500,000 loan amount, and if you can see that if you are looking for a property, like monthly repayment is roughly around $2,997 with an approximate 6% interest rate for 30 years. And if you are making a fortnight repayment, the payment is going $1,498, and the loan will be finishing 5 years earlier if you are making a fortnightly or weekly payment rather than monthly. If you are in monthly, the loan will be finishing in 30 years, maybe 1 or 2 months earlier. But if you're making the fortnightly or weekly payment, the loan will be going a lot early, 5 years less. And on top of that, if you are happy to make some extra payments on top of that, it can be a random payment you can make into, or you can set up a scheduled transfer, make another $100 or $200 in a weekly or fortnightly basis, and your loan will be finishing a lot earlier too. So, and we are saving a lot of interest. You can see that you'll be wondering, actually, if we are making another repayment, extra monthly repayment of $500, I know it's a bit tight for us, but if we are struggling, if we are taking a bit shift extra or doing a bit of overtimes or anything, and we are paying that $500 extra into the home loan, so we will be paying off that loan a lot earlier, which is 21 years time we can pay off the loan if we are paying in such a way, like in a bit of money, keep a bit of money extra from any activities we are spending. So don't try to make money or accumulate money and pay off, always make a direct debit setup or always try to do a scheduled transfer, because we are people, if I have $1,000, I know how to spend $1,000. But if I have only 900, I'll be spending only 900 because 100 is already gone. So do a habit in such a way, like to make some additional repayment without your knowledge. The salary is coming and you just make a direct debit or a scheduled transfer setup on the next day, so you won't see that money. So it's going to your home loan. And if it is paying us an additional payment, if you have any emergencies, we might be able to take us a cash out, or you might be able to take us a redraw in any emergency situations too. That will be helping you to manage it nicely because you won't spend that much of money. And in that situation, you can see that the interest you saved in that much of 21 years is $199,000, which is not silly. So roughly around $200,000 we are saving in a mortgage if we have $500,000 loan and $500 monthly additional payments when we are paying off. So another option, so you might be paying maybe 6%, 6.2% interest rate now at the moment. So what we can suggest is we can refinance your loans and move into another lender, reduce your interest rates, and your monthly saving or your weekly saving might be maybe a $50, $100. Put that extra money into your home loan. Don't do a party with that extra money which we are saving by the refinances. Put back into the home loan. And whenever the interest rate is going down, so you might be saying that recently in last 2 RBI sittings, the interest rate has gone down. You might be seeing that your banks advised you as your interest rate has been gone down. And some of you might be called your brokers or your lender, oh, my repayment is not gone down. Everyone is complaining about that. And we will tell them, okay, don't worry about it. So let the bank to take the repayment on the same way what they did. Because each single dollar extra you paid is going into your mortgage and going into your principal amount. So your loan is diminishing according to that. So don't reduce your repayments when the interest rate is going down. Keep as it is. If you have a hard situation, very financial hard situations, okay, just reduce it if you can't manage your expenses. Unless, let it go. Don't tell the bank to reduce it. The bank will automatically reduce the interest rate what they are charging. But keep the payment as it is. Because that will be another option. You know, like when we are refinancing, just tell them, okay, keep my repayment as it is. Or you just ask us, okay, how can we reduce in 20 years? We will tell you, okay, how much extra repayment you need to make it, and we will tell you to do as an additional payment every month or fortnight. And if you don't want, you can stop at any time. So that is the best option you need to arrange from yourself, you know, like to reduce the home loan and its interest rate over the period of time. Another thing is the investment strategy, which in all these situations, you might be seeing that the loan is going into, okay, you did refinance and you saved some money and you're putting into the loan and you are contributing $500 every month to the loan. Still it is sitting in 18 or 19 years because it's a heavy mortgage. So it won't go very silly. So what's the another option is, okay, I'm just going to tell the reverse side of that. Take some equity, increase your loan, okay? Purchase a property. A small property, don't go for a $1 million property for an investment unless if you don't have a specific plan for a development scenario. Unless if you just being to be an investor, just buy a smallest property, the smallest properties will be having a very good yield in rental repayments. So don't go for a $900,000 property and don't buy in Magil or somewhere, you know, 1 million and renting out for $700, $800. It won't help you unless if it is not a long-time investment or there is no any subdivision scopes. So go for a smaller property and try to pay off maximum its rents and things. And so what happens is eventually maybe after 1 or 2 or 3 years or 5 years or 10 years, let it go as it is and the property capital gains will be coming up. Sell that property off into the market, take the capital gain, pay the tax to the government, whatever is legal, the remaining is going into your property. So that will diminish your home loan very sudden. So that's why we will always advise people to purchase a 500K, 600K property. You just invest into that. Okay, we will be having a bit of struggle. We might not be able to put $500 every weekly or every monthly into the property. So you can get a property portfolio and you can generate your capital gains in that property. And once you are selling, whenever you are selling that property, that savings after the tax will be going into, you can put that into your existing property. That's how a lot of people are reducing their mortgage a lot earlier, maybe even 8 years' time or 10 years' time. Because this is what you can see in our community. Like a lot of people are purchasing the property, they might be selling after 3 or 4 years. If you imagine, if you bought a property 3 or 4 years back, like in $700,000 or $800,000, that might be, 1 million or 1.2 million. That 300,000 after the tax, you might be having maybe a $200,000 in your pocket. Just put into the loan. That's it. So your loan is reducing. According to that, your monthly repayment is going as it is, and more money is going into the capital, which is going into the principal, and the loan will be going down. Because we need to do all these tricks and tips, to get the property mortgage going to be down into the lower scale and to be mortgage free. Always utilize the equity, always try to put maximum input into the loan, or in any other situations, try to reduce your interest rate and use that advantage, put it back into the home loan, don't spend it off, and that will be reducing your mortgage principal size, and it will be making a benefit on the future repayments. And another topic is super fund investments. So super fund investments, we all know that we all might be having maybe $100,000, $150,000 super fund savings with us. This is not a very elaborated topic in long time back, actually, because super fund was a very scary thing for everyone. Because and the government restrictions. When I arrived in Australia 20 years back, the first thing was we've been telling it's not the money for me, because we don't know whether we'll be living up to that time when we are getting into 65, 70 years old and retirement time, and I don't know whether I'll be using this is the money for my kids. But things changed, because now we can, not now actually, because self-managed super fund started a long time back, because I made my super fund into self-managed 9 years back. So self-managed super fund is the option, like you can utilize the super fund and you can use it on your own control. So now it is sitting with any of the super fund companies, maybe the state government super or like an Australian super or any other super companies which will be holding your fund at the moment, and they are investing into real estate, or they are investing into mutual funds or other investment venues where they are comfortable or share. So when doing the self-managed super fund, you will be legally setting up a independent super fund by your own with the help of an accountant. Some of the accountants won't do it, and ATO is giving the legal authority to do self-managed super fund setup. So in that self-managed super fund, you can, after the setup, you will be able to bring all your super fund into your own control. But be very careful, you are not allowed to mismanage it. It's very illegal if it's mismanaging. It's very punishable. It will be attracting imprisonment or heavy penalties if you're managing it wrongly. The ATO is trusting us, letting us to manage the super fund ourselves with all the controls and annual auditing and with all these things. So when the self-managed super fund, the fund is coming into control, you'll be having a bank account which is setting up with your normal everyday banker. So the fund is coming into the account, and we will be using that fund to purchase an investment property. So if you have 150, that 150 is coming into your self-managed super fund, and that 150 is using as a deposit and the stamp duty cost for the next investment purchase. So without touching any single dollar from your pocket. So when the property capital gain is going up, or whenever you're selling the property after a long time, so that is your super. So the capital gains which is going to the super, and you will be able to take it as normal after the retirement according to the government laws and regulations. So this is a way. Your money is sitting with someone now at the moment. So your money is sitting with someone now at the moment. They are investing into, so you might be seen in that last global financial crisis, a lot of people lost a bit of maybe a 5% of their super funds due to the investment shortfall happened on the real estate investments over Australia, or with the share industries or the mutual funds. So a lot of people lost that, but no one checked the super funds, or no one is looking into the super funds unless if you are not telling them, then money is gone. So if it is sitting in a property, yes, the property is going down, okay, we will be having a financial crisis maybe in every 10 or 15 years in Australia or in the world, like in the property market might be going down, but still keep it renting. Don't sell it. So we'll be selling only at the point whenever we feel like that's made a profit. So that time we can sell the property and we can get the capital gains and investing back into the super fund, and you can use that as a savings for all our retirement life. So that will be increasing the super fund. So this is totally advisable based on how you are managing and how you are investing your current super, whether you are getting a very good returns, maybe a 10% or 15% returns. I won't suggest you to do a self-managed super fund, but most of the people, their super funds are sitting somewhere. They are not watching, they are not monitoring, it's going somewhere. So that's a good option for everyone who is doing that. Just invest that into a property. It's very straightforward. There is no any dramas. So you can easily do that super fund investments in that. So you can see the market in Adelaide, all the states, all the capital cities, the market is going still high. And we are predicting in 2026 financial year, Adelaide will be going another 5.5% high growth in that again, because north and southern part of Adelaide is getting too expensive now at the moment. So in SMS, which is calling self-managed super funds, we can purchase residential or commercial properties. So which is all based on maybe 20% deposit. For commercial, sometimes we need 30% deposit, which is warehouses or factories or commercial buildings. But there are some regulations actually, because if you purchase a property in self-managed super fund, you cannot live in that property. That might be a question coming later on. We cannot live in that property. We are not allowed to live in. It should be independent. That has to be rented out to someone. And we can't live in any situations in property. If it's a commercial property, there are exemptions. You might be hearing the names like Granite, Pepper, Black Shop, Liberty, and all these theatre lenders who are specialized in that space. The interest rate is a bit high. It starts from 6.89 onwards. Some lenders, they might be doing it lower, but we might not be getting much borrowing capacity in that space, because we are playing in a small space of lending area, that one. And when you're purchasing a property, it's not affecting if the property can survive its own. I mean, if you can repay the mortgage and everything by the super fund itself, it won't be generally considering as a liability by any of the lenders, and it won't be affecting any of your personal borrowing capacities in that situations, and which is always categorized as a limited recourse borrowing arrangement, which means like in that properties are purchasing on a super fund and a trust or company structure. So in that situations, it won't be affecting any of your personal assets if there is anything happens, unfortunately, in the future. So that's very regulated and kept separate away from your normal assets and things, if you never plan anything purposefully. Yeah, like in that's the case. So that's the SMS of topic. And the super funds in Australia, I'm not allowed to tell us it's not safe actually, but in a general analysis, usually we used to take data from ASICs reports and all these things. People lost the super fund, like in 12,000 people were exposed to 3 major failed schemes. 1 billion through collapsed in super funds in the last GFC time. So this is all affecting us. And this is all the topics what we mean to tell you in tonight's session. Anyone having any particular questions about any topics what we discussed? I have some other topics on top of that. If you want, I can just go through those topics in detail. There are some LMA exemptions I just introduced at the beginning, because there are some LMA exemptions for some categories in lending. Some of the LMA exemptions are 95% lending. We can do 95% loans for investment properties, which was not possible previously. And now at the moment, we can do 95% for investment property purchases. And some categories we can do, as I told you, the NHFIC scheme, we can go for 95% without LMI for first home buyers, for residential, primary residence place. And for nurses, registered nurses particularly, or some medical professionals, they might be able to go for 90% without lender's mortgage insurance up to any purchase limits with some of the lenders. And some aged care workers will be having an exemption for 90% LMI exemption with some small lenders, which is not with any of the major lenders, but we are doing some of the lenders which might be, if your incomes and your financial situations fit in that, we might be able to try for 90% LMI, without LMI, 90% loan for some aged care or health sector workers. Some lenders will be taking self-employed. We can use the ABN. We can use the last financial year income for any business people. So that are all the exemptions we are getting in some lenders. So I don't know whether the topic is related to everyone. And some lenders will be having if you are paying a higher interest rate at the moment, say for example 8% or 7%, it's very rare, but some of the lenders are giving an exemption on the income area, not in the income area, in the assessment buffer level, and they will be giving maybe a 1% discounts on the assessment buffer level, and might be able to pass through those lenders who are participating in the CCR and all, and we might be able to move into a safe major lending space. Major 4 lenders are playing that space because to support the people who are paying high interest rate and they're stuck with somewhere, and they will be giving an exemptions accordingly to give a refinance option with reducing the assessment benchmark rates with the concern from the R6 and APRA. And we have some lenders will be, usually another question we will be hearing from people are like, can we get a cashback? Okay. So I do recommend the cashback for some banks. Some banks are doing $2,000, $1,000, even $3,000 or $4,000 cashback. That's based on the loan amount. But always be very careful. Whenever you are going for a cashback, make sure whether that worth for you, whether that interest rate is suitable for you. So we might be able to have another products which might be having lower interest rates, which is aggregating in 1 or 2 years' time, which is equivalent or cheaper than the cashback offer. So that's another topic we always need to educate people about it. We never just refinance anyone for a cashback perspective. We will be always looking into whether that cashback is worth for you. That's another advantage when you're going for a mortgage product, because we want you forever. And we want to work with you and we want your referrals. That's the only thing we are getting business through. That's why very luckily we are doing good business, because we had a very good reputation in the market, because we are pretty good to talk and to explain things in very clearly, because we need to see your face tomorrow, because it's not like a lender. Someone sitting in our face, they don't have to see you, this has happened, but we need to see you tomorrow and day after tomorrow in anywhere, because it's a small place. It's a small world actually. So you can expect a very professional advice from us. So I think that's kind of what we prepared for. We have a lot of topics, but it's a very big topic. The lending, it never ends, because we need to tell about a lot of options, things that is all based on individual scenarios. We might be having a lot of options, but not for everyone. That will be on particular people, particular space, self-employed and all these things. Yeah. So I just touch base only with a little topic, not to get you bored. So if you have any questions, feel free to ask me. If I know, I will tell you. Otherwise, I'll refer and tell you. Yeah. Ask any questions. Don't worry about it. Existing year loans or anything. Yeah.
When you're looking at collateralizing, so hi, my name is Sriram. So my question is on the parental guarantee to enable children to be able to get into the housing market. So when you talked about the parental guarantee and the deposit, when you securitize or collateralize your house, is that taken as a part of the loan, or is that just a guarantee?
So different lenders are working on different space actually. So if you're comparing with the major lenders, some lenders will do a second mortgage. A lot of people might not know second mortgage what actually, because very rarely, that's a very rare space actually. If the parents are having a loan with a lender, and very rare banking, it might be possible to do cross-collateralize without moving the existing lender and to take from another lender. It's a very rare piece. Okay, so some lenders might be doing in a low LVR, which is loan to value ratio, which is a technical term LVR. So very rare banking, they might be doing a second mortgage, which is existing lender having a mortgage, which will be at 20% or 30%, and they will be attaching that property. And in that situation, that particular banking should be having a role, then only we will go into that banking. And the banking which is holding the property in an existing situation, they must accept that too. Some lenders does it, some lenders won't do it because they don't want to touch on my property. So it happens. Or in another situation, so we will advise, if the parents have servicing, we will advise, okay, can we move you into this banking where kids getting more borrowing capacity, because it's all individual borrowing capacity for people. So if the kids doesn't have much borrowing capacity in that X banking, they will be getting that in the Y banking. We don't have any option because we can't get enough borrowing here. There is plenty of equity actually. And we will bring that parents' loan if they have sufficient borrowing capacity and move into here, and we will attach that and we will take for the kids. Unless we will, firstly what we will look is, we will try to retain the parents' property because they might be nearly paid off. They don't want to take the hassles, but they don't want to spend another $700 cost in moving a mortgage. So we need to be gentle to them, and we will try with that particular banking at the beginning that is more comfortable for the parents, and we will take the kids into that banking. So that's the first option. We will be always trying. We'll look the borrowing capacity of the kids and see whether they can get it, and with the consent of the parents, and we will usually see the parents ourselves, and we'll make sure, okay, are you happy with that? Your property is sharing to them, and in worst case scenario, if the kids never pay it, the property is locked. So to be very careful in that situation, but a lot of Australians are preferring that way rather than giving physical money to the kids. They are letting them to attaching the property. And some banks, they want to check whether the parents have the capacity, and a lot of banks, they don't bother about it. They only just need a consent, that's it. And after that, whenever this deal is happening, there will be legal financial advisors need to be taken from solicitors, and we need that bit of documentations will be extra, and some lenders are giving a pass-through on that now at the moment, and some lenders are tightening the rules recently. So did I answer your questions perfectly?
Yes. Okay. I have another question.
Yeah, sure. Yeah. Okay.
The other question is, so consider that if I have an owner-occupied property, also have an investment property, and I sell my owner-occupied property, current owner-occupied, and move into the investment property as owner-occupied, and pay down, the investment property residual loan from the capital, from the gains, because there won't be any capital gains tax on that scenario. Is that a scenario beneficial to then look for another investment property to maximize capital gains?
Okay. I'm not a tax expert. I mean, I know the taxation things, but I'm not allowed to tell the taxation portion of that. As a friendly thing, I can tell you one thing is, see, in my understanding, you have a primary place of residence, which is owner-occupied, and no capital gain tax for that, according to the Australian law. And you have an investment property. As you are doing negative gearing for that investment property, and you're planning to go for next investment property after the sales, actually. Personally, I won't recommend you to pay off that investment property, because once you pay it off, you can't do the negative gearings or any taxation benefits on that property which you are having now at the moment. I will recommend to you one thing. See, end of the day, if we have investment property and we don't have any loans anywhere, we need to pay off. Don't worry about taking 30% by 30 cents by losing my $1. So that's not a good mathematics, because I don't want to save 30 cents by spending my $1. That's not a good business. So in that situation, I will recommend you, see what you are planning actually, whether you are going for upgrading or whether you are going to purchase a next owner-occupied or not. Because eventually you might be having a plan to do it. If you are keeping this property as investment, don't pay off. If you are going to live in that property, pay it off. and take the equity from that property physically through the banking, put that equity as a deposit for the third property, which is going to be a real second property, which is in planning third property. Take the equity physically from that property, which is giving a loan to you, and go for purchasing without having the physical cash. So you can do 100% negative gearing. Is that right? Yeah. Sorry, it's a bit complicated way we need to tell it actually. So two options I need to give him, because one is the best option, what generally everyone thinks, but the other option which is for saving a bit of tax. Yeah. So yeah. Anything, always welcome for any questions. There is no silly questions or anything yet. So. Yes. Yeah.
Hello, sir. In regards to the self-managed super funds, for instance, like, as you said, you can use the self-managed super fund to buy the investment property.
Yes.
In case in the future, like, maybe like 4 years or 5 years, if the, the value of the properties goes up and we are planning to sell that one. So whatever the profit, will it be gone back into the super, or if we can able to utilize that profit to pay off our, owner-occupied ones?
Got it. First of all, I forget to tell one single word. The super fund is your fund, but that's not your fund right now. We are just the managers. I mean, we all are just the individual managers of the super fund. We are not allowed to touch for any personal benefit with that money. So definitely when you sell the property, the whole profit will be going into the super fund. So that is the case, and that will be attracting the normal Australian, I think it is 15%. So normal attracting normal capital gains or whatever according to the super fund rules, then the money remains in the super fund. And you can maybe purchase another property after that. And we are not allowed to take equity from a property which purchased through super fund, which is not allowed. Yeah. So always we'll tell, if you have $500,000 in super fund, don't use that whole $500,000 for the property purchase. Use only $250,000, because once you put into the property, not allowed to touch it back unless if it is not selling. Is that correct? Yeah.
And
super fund has a flat tax of 15% in general. We all say there's no tax, but there's a 15% tax in my understanding, but that will be attracting to the flat tax. In my understanding, not allowed to tell. Yeah. Should be, but need to discuss the account in that one.
And another one, so as you said, for the home store,
yeah.
Does it applicable only to the first home buyers, or it can be implemented for the investment property as well?
No, homestead is only, not for the first home buyers. Homestead is only for purchasing an owner-occupied property. A primary place of residence, which is the one I need to go and live in that property. 1 year back, Homestead used to give loan to people. If I have an investment property, okay, I rented it out, or I am going to rent it out, and I'm going to purchase a property to live in. Homestead used to give the loan, but then now they stopped it. I must not have a property if I am going to purchase a property, and compulsorily we need to live in that property. That's a good initiative by the state government, even if the interest rate is higher. That's to support people to afford a house here. No investments here. It used to be, people used to use it wrongly. That's why Homestead realized it, in the shared equity options and all. That was a great thing actually, but which is federal government is restarting now the shared equity booster things and all now, which is started by state government a long years back. That's why Homestead stopped it literally. Yeah. Ask me.
Thank you.
No questions? Feel free to ask any questions here. I think you have some questions. Don't worry here. No, anything? That's good for them actually. So yeah.
So the other question is on the self-employed.
Yeah.
The other question is on the self-employed piece.
Yeah.
So while I see that there's no minimum ABN rule for self-employed customers up to 80%, so there are some lenders who just started with one last financial year's,
Isolation.
isolation. Does that also only lead up to an LVR up to 80% or?
The 1 year isolation is controlled by 80% LVR. I mean, potentially to avoid the risk of, like in future, in case bank need to sell it off and no need to lose anything. So isolation is generally sitting in 1 year. 1 year isolation is generally up to 80% LVR. And there is another rule like in which is some lenders which we use, they doesn't need a one full year. Like in most of the lenders having a rule like the business ABN has to be 2 years for considering the business income. So that's a big question, and a lot of people are using Uber and all these new businesses having a very big profit. They are not able to get into the property market. So that's why some lenders are giving a bit of flexibility in that space, and they are not strict into have a 2 year ABN holding. The business has to be profitable. I mean, like in terms of the banking transactions, we'll be looking in other ways. But 1 year, like in even 1 year tax return, or the directors having sufficient fund to take the salary from the business as well, and will be like in scrutinizing very well that one. It's not an easy piece, like in that will be having scrutinities and things for good businesses which is running very profitably. In that situation, we might be able to get exemptions from the higher credits based on reviewing all the documentations and their financial situations and strictly into 80% LVR. But we do have a lot of lenders which is having business people having a lot of businesses. See, it's very hard to get the documentation from the business people who is actively and very profitably doing business. They'll be having multiple structures and all. In that space, we might be using lot of options. So particularly with the GSTs and returns, and we'll be checking the bank statements, then we'll go for the lot of options. Yeah,
So in the scenario that I'm talking about, is my daughter was a sole trader.
Yeah.
Now she's moved into a company structure.
Yeah.
Sales, she's got a GST register and BAS statements for production.
Obviously, GST register means the turnover will be higher and the profit will be absolutely higher. Yeah.
So from that perspective, she's only 21.
Yes. Yeah.
And so she may be perhaps in that bandwagon of the first home buyer. So I think we're just looking at from that.
Yeah, the business is, we can prove the business is going good and the transactions are pretty good. We might be able to have a look onto that, and we will get the details actually. And when the sole trading moved into a company structure, because some lenders they will be specifically looking into that, whether is it the same business or how was the business structure and all, and when converting into the PTY limited structure, which is proprietary limited structure, and we'll be comparing all those conditions, what was any debts, and we'll be analyzing everything, and we'll be operating it very well. So then after that, we'll be getting into a situation whether it can be considered. Why not? We can have a look into that. Yeah, absolutely. We'll be having a track on that. Yeah. Or otherwise, we might be going for law docs or anything, but it is attracting higher interest rates eventually. But the transaction has to be very heavy in that situation. Yeah. So yeah, why not? Please let us know. Yeah, and we'll have a crack. I'll get back to you later on this.
With the self-managed super fund, can the property be bought on the partner's name? If the husband is staying in a super fund, can the property be bought in wife's name, or it should be under a trust name?
In self-managed.
Yeah.
Okay. First thing I will go from the scratch. The self-managed super fund can be on individual name or can be with the, you mean partner, wife or someone, right? Yeah. Okay. So can be on joint name. Okay. So I lost there actually. Is there a managed super fund at the moment, or?
No, in case if you want to go for that.
Or if you want to go for that. So if we want to go and buy individually, if husband and wife don't want to join their self-managed super fund, they can individually create the trust and manage the super fund. But mostly people will be combining, and husband and wife will be the trustees, will be a part of the trustees of the super fund trust. Then they will be creating a company which is a corporate structure will be developing. Then husband and wife will be utilizing their super fund and bringing into a big super fund and bringing into big borrowing capacity and buying a property. But the property is not on your name, sir. The property will be on the super fund trust name. And there is another twist in that. It's not just a super fund, there will be a bear trust. Because that's where the record thing is working. There should be another bear trust, and that will be coming into the title. So it will never be into an individual name. It will be into a company or trust involved name. Yeah. So it never been individual. That's where the liability is limited.
So you can't mix your equity and the...
No, not the personal. See, I can't say no. Honestly, I can't say no. For tax savings, it's coming into a bit of a deep investment structure. I will tell you if you got time. If I have a good profit in any business or anything, I can shuffle allowed super fund limit into a particular number of years into my super fund and save my tax and all these things according to my accountant's advice. Then I can use that fund diverting into the super. I took a part of super. I can't take it back anymore. Okay. Then that will be pumping that deposit level. So which is doing by generally business people. So the super fund limit will be elevated, and that will be a good funding for purchasing a higher property. So that's the reason usually. Otherwise, once we put our own money into super, that's the money which is going to be our own tomorrow. We don't want to lock it. You can, but we won't recommend that one. Why don't you buy a property by yourself? Easy. Any questions? First-time buyers, investments, super funds?
So, in terms of investment property, if both husband and wife works together, they maximum they can own one or two properties, is it?
Sorry.
They can own more than maximum of 1 or 2 properties?
For investment?
Yeah, so the borrowing capacity actually stops there.
Okay.
So the other option I heard was to open a trust account. So what are the pros and cons of that? Because the borrowing capacity will not help you in more than 2 properties, I think.
Yes, yeah. Depends on the income. Yeah, it will be limited. I got you, Excel. Yeah, I totally understand your question.
If you're trying to open a trust account,
yes.
How is it going to help you? What are the pros and cons?
See, I do have, if you have 10 business plans or 10 investment strategies, I will be having 10 strategies. Okay. If you have 100, I will be having 100 ways. The pros and cons, that will be decided by what brings me there actually. So I will be doing that for trust or company structure for purchasing an investment property. There will be a reason for that, for me to purchase more properties. Okay, so we will be having some customers contacting us, okay, Shibu, we need to purchase 10 properties. Okay, so I do have a customer, he wants to purchase 20-25 properties in 3 years' time. So the income is really good. And we are settling the 7th or 8th properties in last 2 years, like in next Monday.
That's right. People can buy
so
property.
That will be a plan. We need to make a plan. So don't go for a trust or company structure when your borrowing is finishing. You won't get a borrowing because no one gets a borrowing capacity when they are purchasing on a company or no one get it. But if you want to go on that direction, you need to plan ahead before finishing it. I think you are just starting to invest now, isn't it? We definitely need to say how you need to structure that plan. So that way is not at the end. We need to plan early. So hopefully people will be having a thought, I need to buy 6-7 properties. Okay, so they need to plan that ahead, not at the last minute.
So structuring is the matter.
Structuring is the biggest thing.
Because income won't go higher.
Income won't go high because the property borrowing is finished. How can you buy on a trust or company? No, you can't. That never give you borrowing capacity. The individual asset protection and liability protection is making you capable of purchasing more properties. Only if that property can be that particular under business or anything, only if it is possible to repay its own commitments and not affecting any of your personal income or not committed into that area, then it will be possible. But that planning need to be started at the beginning while stepping into the first property.
I see.
Yes.
Thank you.
That's a good idea, actually. So can't say pros and cons because that's why I told you, we can't say pros and cons of that because the people will be going into only a direction because they have a mindset, I need to have multiple properties. That's what I want. Yeah, so you don't look into the little losses due to that because there will be always a gain. Don't worry about the little losses. Think big here. That's a good thought. I like it. Anything? That's a good question, actually. So he's in right spot here. I will tell you the frame structure. Okay. Negative gearing means when we have an investment property, we will be having income and losses in investment properties. So always it's treating as a business. Like purchasing an investment property is treating as a business. So when we will be having income, which is the rent. The expenses are the interest rate, not the repayment, the interest rate. The interest rates and fees and charges, the insurance, these all part of the expenses of maintaining that particular individual business. Income minus loss, it can be positive or negative. If it is positive, that's positive gearing, which we call as positive. It is negative, that means negative. ATO will be charging the tax for the profit, which is positive. And ATO will be giving an exemption or trying to share our loss, which is from the top tax cut. So that is calling negative gearing. I think that's the only way I can represent it as not being an accountant. There is a limitation. There are limitations to go beyond that limit. But that's the basic structure. Any topics? That will be good actually because you know a bit of things to ask. Really? Yeah.
My name is Prakash.
Yeah.
I have a question. For self-managed super funds,
Yeah.
other than investment options, what is your suggestion? Like other than property,
Yeah.
what are the investment options? Like go for equity investment in Australian share market or US share market or Japanese? Can I take the fund outside the country and bring it back?
I did invest in overseas.
I see. That's interesting. Yeah.
It's not an easy way.
Okay.
It's the hardest way. So I did invest in overseas businesses actually, but it's all based on the regulations.
Okay.
And definitely you need to sit with the accountant,
Okay.
not just a normal accountant, an accountant who knows that all options of investing. There are investing options, I know that, there are options. So I need to discuss with that and ask them. If you are doing overseas investment, that's so easy because you need to prove because the taxation systems, taxation times, even just example, in India it's different, in Australia it's different.
Okay.
That need to be matched, and you need to have a chartered accountant over there. You need to have a chartered accountant here. I have sources over there. That's why it's so easy for me.
Okay.
But it's you need to convince that the chartered accountant here as this is all going good, and whatever you are showing in the white paper, no one believe it.
I see.
Like you need to be very transparent. And as I told, this is a very hot piece. So always try to invest in the mainland. I mean, like in Australia, like in any other sources. Share and all, I think that will be possible, definitely.
Thanks for the
Yeah.
clarification.
Yeah. Anyone?
Good evening, Shivu. My name is Rangarajan.
Okay.
With the self-managed super funds, there are multiple avenues to invest that fund in property or other shares or other modalities. But what's the biggest benefit to move from, let's say, a super fund to manage? I understand there's a lot more obligations to paperwork and those sort of things involved.
In SMSF?
Yeah, is there?
Pretty much SMSF documentations are not really hard. So you need to have an accountant who will be able to help you on that and give a bit of advice on that. Pretty much the setup takes roughly around 6 weeks' time. You need to sign the forms and they will do all the remaining minutes and all these things. They will create a company, they will create a trust, and they will set it up. And some of the accountants, they will be helping to roll over the fund as well. Even you can do that too. Set up the bank account, not had, like you need to physically go there and you need to give the trust documentations and everything to do it. Once someone set up the account, so that's easy, pretty easy. You mean like to bring the money out or like to purchase a property?
Yeah, before we make an investment decision, so I'm trying to compare what's the savings in the cost, because the super funds are obviously charging a lot of admin fee. And
roughly around, if you're going for a property, if just setting up the SMSF only, that might be costing roughly under $2,000. But if you're going for a property which need to bear trust and the company structure and all need to be created just before signing a contract of sale for purchasing a property, that will be attracting maybe another $2,000. According to the accountant, we do liaise with a lot of accountants in all states in Australia as well as outside. But usually I had the cost like $3,500 to $4,000 till the end of that bed trust and setups. Then every year you need to have a maintenance cost, which is roughly around $1,000 to $1,500 auditing fee. So that need to be taken care of. But see, compare your current investments and check it out with whatever the profit you're making, and look into the market, the property market, and analyze for the last 5 years and see how is the capital going. And we might be expecting another 5.6 to 8%, 5.6 to 7% capital growth maybe in this financial year as well. But it won't be going in 2025 again because it's too much now. So yeah, just look into that and see which one is balancing. Yeah, that'll be a pretty good idea. Yeah, so.
On that, once the accountant sets up, so where is your work comes into picture?
Okay. Initially, before going to the accountant, we will check the borrowing capacity. So we need to see whether this fund is enough or this loan amount is enough for purchasing according to individual's need. So we will check that first. Then after checking that, we will tell you, okay, just contact the accountant if you're happy. I mean, if the person is happy, we'll tell, okay, contact the accountant and set up the trust and things. Once the trust is set up, we will start the pre-approval. So we need the trust documentations for the pre-approval, and we will start the pre-approval process from there. The pre-approval is roughly around 2.5 weeks time, depends on the lenders. And then after that, you can hunt the property straight away. Done.
Thank you.
Hi, this is Karthik.
Hi, Karthik.
For 491 visa, we are in temporary visa.
Yes.
So can you give some points to whether we can buy in our house or still we have to wait for until PR?
I think 491 is 4 years or
3 years. Visa.
3 years, yeah. So remaining 1 year, 2 years for you?
1 year.
1 year. So 491 is a temporary work visa, which will be leading to the PR.
Yeah.
I think maybe after 2 years or something we'll be able to.
3 years exactly after we complete our tax.
Yeah. So definitely you can purchase a property, but the federal government made a rule in April.
Yeah.
You cannot purchase an established property for next 2 years, which is totally banned.
In established property, and one more thing, just now today I saw something. If they are going to renovate something, renovation done, then we can enter as it is something new.
I don't think actually, because it says about land and construction, yes, you can do that. And even if you are purchasing an established property, see, for example, if the government is approving you, still you need to pay normal stamp duty plus 7% extra stamp duty.
It differs from state to state.
State to state, it differs absolutely, because usually everyone tells the stamp duty is 5%, but it's not 5%. If you're going to purchase a $100,000 property, the stamp duty will be roughly around 3.3%. It's not 5%. So the South Australian levy is 7% on top of the stamp duty. So roughly for a random number, we will be always telling us it will be a 12% stamp duty you need to pay in SA. Other state, it is different.
For in Canberra, ACT, they think that they are not paying that extra.
Yeah. Yeah, some states having
just 5% there, as other PR how they are buying those houses.
Yeah.
They are
Canberra is having some exemptions. Yeah, Capital Territory having some exemptions. So
the same 491 visa holder that he bought this new house.
Yes. Yeah.
And same he got first home buyer allowance also, and as well as only 5% tax what he has paid.
Yeah.
If we are going to buy here, we have to pay 12.5% there.
Yeah, 12.5%. Yeah, that's the South Australian rule. Yeah. Canberra have a lot of exemptions for the temporary residents, but NSW, Victoria, QLD, they are all having the levy charged. QLD didn't have the levy 2 years back, but they recently, 2 years before they just started that. None of the states won't give, I think NSW used to give some exemptions on that stamp duty levy. They used to refund within 1 year time period, but every state is acting individually. Every revenue departments are individual. They have their own individual rules actually. So that's according to that.
One more question. Sorry to interrupt you.
And one more thing I missed to point out to you that, and whenever a temporary resident is purchasing a property, we need to have FIRB approval, which is Foreign Investment Regulatory Board's approval. Before changing this ban on April, for land purchases or brand new purchases, it was 14,300, and for established properties, it was $44,000. So everyone stepped back from that anyway, because 44 plus 12% stamp duty, that's a heaps of money actually. So
if we are going to buy a land now,
always good. I will suggest you.
Yeah. So still we have to pay 14,400, or
yes,
how
you need to pay the FIRB, definitely 14,400. Yes, that's us being a temporary resident, and you need to pay the stamp duty for the land portion.
Stamp duty. So
Yeah.
how much?
12.5%. Yeah. Stamp duty for the land portion. That's always good actually, because if you're aiming your PR in 2 years' time, I can't advise you to buy a property actually. But if you're thinking the property market is going pretty good, and if you find a small land, don't go for a bigger land or bigger property as being a temporary resident. Always go for the smallest one. And you purchase that land and build a house. When you're constructing, there is no any extra cost than a normal. No, you're just normal.
So under 491 visa, we have a criteria that either land or new house, if you are going to buy, you have to stay and you have to avail that one.
Yeah,
so,
you need to.
So in land, is it possible that we can purchase that one?
You can purchase a owner-occupied land, and so I think you're residing in South Australia, right?
Yes.
Yeah. Okay. So you can purchase a vacant land here. So you need to get the FIRB. Don't take the FIRB a lot earlier. So usually people take the FIRB will be valid only for 1 year.
Yeah.
So you need to take the FIRB. You need to do the paperwork. I mean, like in the preparations for that. Then go for a pre-approval. Then take a land, smaller amount, pay the stamp duties and levy and FIRB. Then do a normal construction and live in that property.
Okay. Thank you. Thank you very much.
No worries. Yeah, perfect. Yeah, I like questions actually. So that's more interaction, sir.
I have my first property as a temporary resident, getting the FIRB exemption and paying additional stamp duty.
Yes.
But I'm reaping benefits now because of that close to about 150% depreciation in the property.
Yeah, so yeah, that's always a good idea, because we might be spending another 30 grand and we don't care about getting another $100,000. That's what mostly what we did, temporary residents purchased a property was NSW. Mostly in NSW regional areas. That's where we did heaps of temporary residence loans. But SA was very much backwarded in that space, and our price was very lower. And I just wonder, why don't people buy in? Because we've been very cheap in the price. It was a good opportunity, but we couldn't find a lot of people to purchase a property here. But NSW was crazy, so everyone purchased a property and took a capital gain of roughly around $250,000, which is nothing when comparing to, So that's good. Yeah, you did a smart decision. Well done. I think you have a question. Do you? So, if no any questions, then we can wrap it down. Thank you for support. And once again, thanks for being patient and listening to us. For welcoming us. Thank you very much to Chris. He did a lot of work, and it was a very meeting. And thank you very much for your valuable time. being with us, and thanks to ATA for organizing such a informative session.
Thank you, Shubhu. Thank you, Shubhu and the team. It was a very good informative session. These events won't be possible without your support. Still, a lot of you all are not ATA members. It's only about $10 a year. Please become a member and support us. We can bring more and more events like this. Secondly, on the September 27th, Deva concert is happening in Adelaide. They're coming to Sydney, Melbourne, and then Adelaide. Loanz is also a big sponsor for them. It's a big concert. So far, everything is happening in Sydney and Melbourne, but this time we are bringing to Adelaide. Vaagai is bringing. Basically, it's a lot of money involved. Please support us, and we can do such programs again and again and again and again. Thank you. Dinner will be served. Please stay for